Good evening, ladies and gentlemen, and welcome to the Trident Royalties PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available on your Investor Meet Company dashboard. I'd like to also remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand over to Adam Davison, CEO of Trident Royalties. Good evening, or good morning to you.
Thanks, Mark. Appreciate it. So we'll get started. I'm actually looking forward to this one. I've done quite a few of these webinars now, and typically you've got a counting down clock sort of giving you 20 minutes, and then you've got 5 to 10 minutes of Q&A, and then they're on to the next presenter. But in this case, I'm very much looking forward to sort of taking a bit more time and could talk in a bit more detail to some of the assets and to the strategy more broadly. And then of course, happy to answer any and every question we get, I guess timing allowed. Start with sort of the typical disclaimer. This is available on our website, so I will save you the burden of reading it now, and you can read that at your own leisure. And just, I don't typically get a chance to sort of delve into my background, but I thought I might take this opportunity to do so. So before I jump in sort of the strategy, real quick, I joined Trident just at the tail end of last year. Prior to that, I was with a mining-focused private equity group for some time, and worked both in Denver and in Perth, Australia, and have done transactions across the breadth of commodities and a number of jurisdictions. And prior to that, then I was in mining, metals and mining equity research with BMO Capital Markets, the big sort of resources-heavy Canadian bank, and prior to that in strategic planning with Orica Mining. And so in terms of key management, it's myself here in Denver, and then my colleague Tyron Reese down in Perth. Ty's background, he's a metallurgist by trade, worked in the mines in Western Australia, largely in copper and gold, and then did his Master's of Finance and CFA, and also worked in mining private equity for some time. And so we joined Trident at the same time. And really since that time, as I said, it was the tail end of last year. So really the first half of this year was spent in going through the process to list on the AIM market in London. Prior to that, Trident was a London-listed shell as a standard listing. We felt that the AIM market was more suitable for the company. The reason being that obviously we're a transactionally focused company, and I won't delve into the details, but that's much easier to do on AIM and facilitates us doing transactions at the pace that we've been doing them. We would be challenged to do so as a standard listing. So we achieved the listing on June 2nd this year. We did so in conjunction with a £16 million equity raise, which leaves us well funded to execute on the strategy, which I'll obviously delve into here in later slides. And really from there, it has been executing on the strategy. Shareholders who've been following us would have seen we've announced 5 transactions thus far, over 8 mining royalties, and are getting a good exposure across the breadth of mining commodities and building out a mix of jurisdictions. So very pleased with our progress thus far. But maybe first things first, I'll touch on what exactly are royalties for those that aren't familiar with them. You know, to be honest, actually, some investors have experience with them or have sort of heard of them. Typically, it's relating to sort of media, movie royalties or music royalties, and mining royalties actually aren't dissimilar in the sense that it's a financial instrument that entitles the royalty holder to a percentage of the revenue of the underlying asset. In our case, that's a mining asset. Now, royalties can be used in other industries as well, obviously. And the way that royalties are generated, it's typically sort of 2 buckets. Quite simply, we're funded with capital. We can go to a mining operator and say, we like your project. We want to help fund you to the next step of development, whether that's funding a study or being part of construction financing. And in exchange, we'd be seeking a percentage of revenue from that asset. And we've done a transaction that was just that. The second bucket of royalties is existing royalties. So there are literally hundreds of royalties sort of floating out there in the world. Many of them held by other mining royalty companies, but many, many more that aren't held by royalty companies. They're held by, in many cases, miners. So through mergers and acquisitions, it's not uncommon for a mine operator to sell a property, but as a bit of a face-saving exercise, they'll retain a royalty over the property. in the event that it enters into production down the track, they can retain that little bit of exposure. But what you find then is they're holding these assets as non-core holdings. For example, if their focus is in precious metals and they're holding a non-precious royalty from years bygone, it doesn't make sense for them to hold it. That royalty is going to get maximum value sitting in a royalty company. And in fact, our most recent transaction announced last week over the Lake Rebecca gold project, that was a legacy royalty held by the geologist that pegged that ground many years ago. So that was not a transaction with Apollo Consolidated, who operates the asset. It was with private individuals. So there's any sort of number of sources of where you can acquire existing royalties. But in terms of sort of the investor benefits of holding royalties, well, there are a number of them, and I'll touch on just a few. The key thing is the royalty, as I said, is a percentage of revenue. So you're getting your exposure at the very top line of the profit and loss statement. This is in stark contrast to holding a mining equity. So if you like copper, for example, and you buy shares in a copper miner, you're exposed to their operating cost profile and capital cost profile as well. So what we found in investing in mining equities, and many investors have shared this experience, is even when the underlying commodity is going well, so you were right, copper performs amazingly well, what the miners tend to do is then turn around and, yes, they will let some of that increased profit flow through to equity, but they'll also take some of it and invest it back into their projects, conduct M&A, try to expand their assets, whether they're expanding the plant production or they're drilling to expand the resource or the reserve. And those aren't bad initiatives to undertake, but effectively you're then getting, as an equity holder, sort of this diluted exposure to the commodity and more broadly to the asset. So royalties are in the beneficial position of, by sitting at the top line on revenue, you're getting that direct upswing. So if you think copper does well, and indeed it does do well, then you're getting that direct upswing because the revenue increases and you're simply getting a percentage of revenue. But then the dual benefit is when the miners go out there and they extend the mine life, well, that ultimately extends the life of the revenue. Or if they double the size of the plant, that increases the revenue because they're doubling production. So all the benefits that equity ultimately gets, and their money is being spent on, that all still benefits the royalty. So in a certain sense, you're getting the best of both worlds. You're getting that asset level exposure because you benefit from when mines are expanded. In fact, there are a number of studies out there, but it's over 80% of mines end up exceeding their initial mine life. So you're getting that asset direct exposure, which you wouldn't get had you just invested directly in the metal. In my example, investing directly in copper, you wouldn't get that asset level exposure. But you're also getting the direct commodity exposure because you're not suffering the exposure to the capital cost or to the operating cost. So that's really the big differentiator between investing in mining equities or indeed in the underlying metals directly relative to a royalty company. And this chart here sort of highlights that. It's using Franco-Nevada, one of I think the second largest royalty company out there, relative to the gold miners ETF. I'd encourage you to look at other peers because this isn't an isolated thing. I think this is almost uniformly true that mining royalty companies tend to outperform their direct sort of mining peers, as well as outperforming the buckets of commodities. And it is because of that sort of exposure that straddles the best of both worlds, as I mentioned. The other thing worth mentioning is royalties, where they sit in the actual capital structure. So equity is obviously at the bottom of that structure. Mining royalties tend to stand above equity and either on par with mezzanine debt or in some cases a touch above mezzanine debt. So that is to say, when the royalty is put in place, jurisdictionally dependent, and obviously a key diligence item when we're looking at an acquisition, but the royalty can be tied then to the ground, and it effectively, when it's put in place, the royalty remains there in perpetuity. In fact, it's not uncommon to see a mining asset go into production. It reaches the end of its mine life, but there's still a resource there. It's just not economic at that time, and years pass, and then it enters back into production again when the asset becomes economic again. Now, if you were equity in that position, you would get that first exposure, and then when the asset ceased to operate, your equity effectively has no value and ceases to be. Whereas the royalty is there forever. It survives bankruptcy. It's tied to the land, and it gets the full life exposure of that ground. And that's really what you're buying when you're getting that royalty over a particular property. So I think what our peers in the precious metals space have demonstrated that that the royalty model resonates well, right? There's some very big market cap companies here, multi-billion dollar companies. And so that's not lost on investors, that you don't have to be a mining specialist to understand the benefits of royalties. So the next natural question we get often is, so what are you going to do different, or what's Trident's strategy that's different from the other royalty offerings out there? I think to preface that, it's probably important to flag that mining royalties as a source of finance have been growing sort of exponentially over the last decade. If you rewind the clock sort of 10 or 12 years, this list, I think, would have 2 to 3 names on it. And it was largely born in North America, Canada and Nevada, the gold producing regions, and largely born out of precious metals in North America. So unsurprisingly, you look at this list, all but 2 North America listed, and the majority are precious metals focused. But back to sort of why we saw a niche in the space, and I think it is, that niche exists because it is still a sector that's in its adolescence and is growing despite the scale of some of these companies. And when you look at this space, I suppose the key thing that jumps out is the fact that so many are precious metals focused. And the genesis in my mind was working in mining private equity, because we wrote many royalties ourselves. And when we wanted to sell or monetize a precious metals royalty, there was no shortage of buyers. You sort of toss it up to the TSX listed precious metals focused royalty companies, and they'll sort of fight each other to pay full value for the asset. But we were left scratching our heads. What do you do with a copper royalty or an iron ore royalty or a uranium royalty? There's just not a natural home for these non-precious metals royalties, we found. And that was really what got the ball rolling in our minds. And when you look at this list in terms of the companies that aren't exclusively or predominantly precious metals focused, Labrador is a single royalty over the Iron Ore Company of Canada, so they're not building a portfolio, and in fact they maybe don't belong on this list. Altius and EMX are both more a project generator model, so almost an explorer in the sense that they'll peg ground, they'll drill it out, and when they sell it, they retain a royalty. And actually, both have been very successful at that. But again, it's a different strategy versus building a diversified mining royalty company. And in fact, Altius also holds a pretty significant portfolio of equities in mining juniors, and also dabbles in renewable resources. So, again, a slightly different offering. And then Anglo-Pacific, I think many UK investors on this webinar are probably familiar with them. Obviously, very heavy coal exposed at the moment. To be fair, looking to diversify. I think more fundamentally, from our perspective, just at a different stage in its life cycle, in terms of looking to maintain that cash flow, maintain their dividend, very much a value sort of offering relative to a growth offering such as Trident. Excuse me. Yeah, so I think what we saw missing in the space was you can extol the virtues of royalties, everything I just described on the previous couple slides, and investors sort of get that, and then they say, yep, so what shares can I hold to give me exposure to mining commodities from a royalty perspective? And the answer is, at the moment, there's not a single offering that in one share gives you exposure to the full suite of mining commodities from a royalty tack. That's not an offering that's in the space at the moment. And by diversified full exposure, I guess the way we focus on it is something that's reflective of the mining sector. So we're targeting a third precious metals, a third base metals, so copper, nickel, zinc, and then a third bulk commodities and battery minerals and industrials and everything else, which is roughly reflective of the sector as a whole. So almost an index fund-like allocation in that regard. So that allows a shareholder of Trident to get full exposure to the full suite of mining commodities from a royalty perspective. And as I said, we're the only offering at the moment that are doing that. And I think off to a very good start. We're only 4 months listed. I've now acquired 8 royalties, and with regards to that third allocation, well, not intentionally ended this way, but we're pretty much sort of spot on in that regard. Obviously, we're targeting the most accretive transactions we can out of the gate, but as it's turned out, we are sort of broadly diversified with gold royalties, copper royalty, and iron ore royalty, giving us exposure to each of those 3 buckets. Now, a couple of the other things that we see as being potential supporting factors in our strategy is, as I mentioned, all these guys, with the exception of Anglo-Pac, are TSX listed as their primary exchange. And the model was born out of North America. So it's not surprising then. If you map their royalties out, what you'll see is very, very heavy Americas focus. Now, they will dabble in outside of the Americas, but at the moment, still very, very heavy Americas focused. And when you look at look no further than our first 2 acquisitions, a paying iron ore royalty in Australia and a paying copper royalty in Zambia. Both the commodity and both the geography just fall well and truly outside the purview of nearly all the peers listed on this chart. And then the final factor is the asset size. So yeah, when you look at this list, there's some very large market cap companies on here. And what you find is they don't delve much below 20 million with regards to a ticket size for an acquisition. It just doesn't move the needle for many of them. Now, occasionally you'll see them do a small royalty acquisition, but it tends to be over an early stage exploration asset that has the potential to become a massive asset down the track. What you don't see them do is buying, for example, a $5 million royalty that will pay $1.5 million a year, for example, for 10 years. That can be an incredibly accretive deal. You know, there's upside to that if it extends its life or increases production, all the hallmarks of a great royalty. But if you're a $400 million company, then your time is better allocated looking at $40 million deals. So with regards to commodity, with regards to geography, and with regards to asset size, we're seeing a huge opportunity set. And I think that's been demonstrated by the pace at which we're moving. So with regards to the strategy is obviously something that we're doing that's different. With regards to the broader business model, it's somewhat comforting to know that we're actually not doing anything. We're not breaking new ground in that regard. Building a royalty company has been done in recent years by precious metals, TSX-focused companies. And we're not taking a different approach in that regard. It is a function of building a portfolio. You acquire royalties, you build some scale and diversification. As you do that, you start becoming valued less as a collection of a few individual assets and more as a portfolio that's diversified. That leads to royalty companies in general being valued at much higher multiples to miners. In fact, a bank report came out this week that largely focuses on the mid-tiers and majors, but flags that the very biggest companies, sort of Wheaton and Franco, are being valued at 3 times net asset value. And it's pretty much a linear progression from there with regards to being valued at kind of 1 times net asset value up to 3 times. And it's predicated largely on how diversified and how large your underlying portfolio is. So, you know, we're in the early days of assembling that portfolio and building out diversification. And as you do that, you know, then you can do things like get conservative leverage against the portfolio. And then further, as you grow, you can swap that leverage out and refinance it and get lower cost debt. But that allows you to then continue to make acquisitions and build the portfolio, but you're not doing continual equity raises to do so. You're using debt that you can draw on, and you're paying it back from royalty revenues. And when you make your next acquisition, you draw down a bit more and you pay it down, and that becomes a cycle that becomes sort of self-sustaining at a certain stage. The other thing we're seeing, and I think demonstrated a bit last week, was where you're able to use your equity. As I said, many holders of existing royalties recognize that they're getting little to no value on their balance sheet. In most cases, their royalties aren't held on balance sheet; they're off balance sheet. So vending it into a royalty company and taking equity in exchange for that can be very accretive for them. The royalty company will get better value for that royalty. So there are a number of opportunities out there that can be acquired, with either a blend of cash and shares, or in some cases entirely in shares. Now, important to flag that we're treating our equity like it is cash. We're all focused on the share price, and that's how everybody is incentivized. So we're not going to throw it around sort of willy-nilly. But that said, it just sort of expands your capacity with regards to ability to do deals. You're not entirely reliant on cash. So between those 3 sort of levers, the ability to obviously use the cash that we do have, and we are cash flow positive, so we also have revenue coming in, the ability to use leverage, and then the ability to use our equity, it gives us a lot of firepower to build out the size and scale of the portfolio. And the ultimate goal is to pass through that cash flow to shareholders in the form of dividends. And so that's sort of first and foremost on the board's mind, and ergo then on our minds. And so we've got targets in mind, and the intent is to then get out there and next year and publish what our dividend policy will be, and then follow that up with a dividend hopefully shortly thereafter. Now, with regards to why royalty companies are valued at such a premium relative to miners, I think it's probably not lost on everybody that as you diversify, there's a risk benefit to that. You start to minimize the risks and you diversify that away, and that's where miners fall short. You can either invest in a junior or mid-tier miner that operates 1 to 3 assets, but then you're completely exposed to those assets. If one operation has a wall failure, for example, you see the value of your equity just crater. So it's an easy comparison to make. If you're investing in a miner that produces, for example, the equivalent of 100,000 ounces of gold, or you can invest in a royalty company that has the attributable 100,000 ounces of gold, but it's spread across 12 royalties in 4 or 5 different jurisdictions. That's just a completely different risk profile. And so you're getting, on top of all the benefits that royalties have that we spoke about, so you're getting a better sort of exposure, but a more with more upside, but also better risk mitigated downside. And that's why royalty companies trade at such premium valuations relative to the miners themselves. Now, I won't linger too long on this, but I think important to flag that whole process of building out the portfolio and then getting valued at a better valuation is driven by the critical mass that's within the portfolio. So the size and scale, the diversification, and this process takes time, and that's really where you see the value uplift in royalty companies. Some recent examples here in this chart: Metalla, Eli, and Mavericks. And I think the oldest there is 4.5 years old, so have not been around for very, very long. And the x-axis on this chart is days since inception of their royalty strategy. And you see there is this period where they're getting some sort of nice value reflected as they do transactions. The share price ticks up. But it really then, you see the real catalyst when they get to that inflection point that I spoke about, which is where you're able to draw on debt, to issue a dividend, to potentially do a dual listing if it's accretive. A number of these initiatives come with the fact that once you've established critical mass, that becomes open to you. So if we're a touch over 100 days in, so we're early on that chart. But I think, as you'll see here, very proud of the progress we've made thus far. And I think it is reflective of the sort of quality of assets and the diversification that we're building into the portfolio. So, I think important to flag that the market's taking note of what we're doing. When we announce deals, we see a positive response. Probably most importantly, we're seeing good liquidity. So at this stage, we've turned over 15% of our register. If you annualize that, that's a good rate. That puts us on par with the mid-tiers and majors in the space. And as we grow, that's undoubtedly going to grow as well. So very pleased with our progress thus far. And as I said, really the benefit is when you build more critical mass and then you really do see that significant upswing. That's what we're all working towards. With regards to our portfolio, as mentioned, we were targeting a third base metals, a third precious metals, and a third bulks and batteries and industrials, and off to a very good start in this regard. This chart here is reflective of the purchase price of the assets collectively, and you can see we're sort of pretty close to that allocation. As I said, somewhat unintentionally, we're targeting the most accretive transactions we can, but good to see that it is, very soon out of the gate, we are presenting investors with a diversified portfolio. The other thing I'd like to flag on this slide is just some of the operators of the assets. I think important to note that we've got some majors and mid-tiers and some juniors, but all highly rated mine operators or explorers or developers. And importantly, credibly advancing their projects if they're projects that aren't already in production. And for the ones that are in production, the operators are all either expanding them or ramping them up or investing in them, all the hallmarks that you want to see of an operator operating an asset that you have a royalty over. And actually, given the time we've got, I'm going to delve a little bit into the assets, which is something I don't normally get a chance to do. I'm just going to focus on sort of our three key assets, but happy in the question and answer to delve in more if needed or to talk to some of the other assets. Uranium was our first royalty. This is the one we listed with. I think this is a good example of a royalty that was in existence, held by an ASX-listed explorer who's off exploring for battery minerals in the Pilbara. They're no longer interested in iron ore. This property was sold by them sort of 10 to 12 years ago. In fact, the management team of the company at that time has all since turned over as well. So it's an example of a royalty that was sitting off balance sheet. But lo and behold, Mineral Resources, a large ASX-listed mid-tier major, picked up the ground, started ramping it up last year, has further ramped it up this year, allocated $120 million to expanding the asset. And so the royalty started to pay, and the explorer that held the royalty, they've got initiatives that they wanted to undertake, and they're willing to take a haircut on value if that means that they can monetize it up front. So we acquired this royalty. Initially the terms were for 7 million in Aussie dollars, and then just last week we announced that it was tranched over 2 tranches, and we've announced that we prepaid the second tranche early, and we did so at what we see as a substantial discount. So we ended up paying 6.65 million Aussie to acquire the asset. Through July this year, it's paid us back 1.4 million. We'd be hopeful that the back half of the year will mirror the front half of the year. Iron ore is the best performing mining commodity this year. It doesn't quite get the glitz and glamour of gold, but yeah, is the best performing commodity. So from our perspective, this one just ticked a lot of boxes. A paying royalty, an asset obviously that's in operation, operated by a major who's investing in the asset. Importantly, it's being expanded. It's got offtakes in place. The risk in many regards is very mitigated by the fact that it is operating. So yeah, it ticked a lot of boxes, and you can sort of do the math on the return profile, and a very accretive deal. Sort of when we did the deal, iron ore was sort of in the mid 80s per ton, and and is now in the mid, sort of hovering around 115. But when we initially did the deal, this asset had sort of a 5-year life and the potential to expand from there if resources converted to reserve. But that puts it at sort of a mid-20s post-tax return, and then capturing a couple early quarters at very strong iron ore prices. That's now a plus 30% post-tax return. And again, goes back to the strategy. That's a great return profile. I think the precious metal guys would kill to find a gold royalty with that kind of return profile, particularly one that's paying. And it's down to the fact that this was acquired non-competitively. It doesn't fall in the wheelhouse of almost any of the other royalty companies. Now, Mimbula is a good example of when a miner would accept a royalty, because I've sort of talked to the virtues of royalties, and I think many people then ask, well, why would a miner ever want them? So in this case, they were ramping up production. They shipped their first copper cathode in June this year. At the end of May, their cash balance got tighter than they wanted it to be. So they wanted to raise a bit of capital to provide a bit of a buffer. And they're looking to list, in fact, in London next year. So they didn't want to go and do sort of a frenzied equity raise in the midst of ramp up and set share price expectations in that regard. So they were open to a royalty. And I think they were just very conscious that it had to be structured in a way that works for them. And obviously we had to be conscious that it has to work for us as well. So what we arrived at was a 1.25% gross revenue royalty. So what that means is for every $100 of revenue they generate, we get $1.25 of it. And we get that rate until we've recovered our $5 million US investment. And then it drops to a 0.3 gross revenue royalty. And it stays there until the royalty is paid on 575,000 tons of copper, which is a lot of copper. So, and then it drops to a 0.2% gross royalty revenue rate. But if we get to that stage, I think we'd all be very, very happy shareholders. So that structure worked for them because effectively, you can, based on the minimum payment schedule associated with the royalty, you can infer that they're looking to ramp this operation up to a plus 40,000 ton a year production profile. And so at that sort of scale, when the royalty steps down to a 0.3%, depending on your views on copper price, that's a sort of $1 million payment a year, which would be a rounding error from their perspective. So that they repay it relatively quickly, and then from there it's a small payment on an ongoing basis thereafter. From our perspective, it's a very, very accretive and attractive royalty because again, you're getting your capital back relatively quickly, and then from there you have exposure to a long life asset. 100 million tons of copper at 1% is large and good grade. You don't find those every day, so you get exposure to a long life asset, and as I said, pays you plus or minus $1 million a year at that lower rate once you've recovered your initial capital. So again, you can probably run the numbers from there, but we're looking at sort of a mid-20s post-tax return. And as mentioned, they're ramping up, and there's natural teething issues that are associated with that. No ramp up goes entirely smoothly. So we put in a minimum payment schedule. So this year it just pays on the royalty rate. Next year it pays on the higher of the royalty rate, or 375,000 US per quarter. And then the following year, 2022, that increases to 500,000 per quarter. And then the following year, it again increases for the first 2 quarters to 750,000 per quarter. So effectively, that sees us repaid at a maximum within 3 years of having made the investment. And as mentioned, they're looking to go public next year, so they don't want us shouting about their production profile, but they are happy to say that at the copper prices at which we struck the deal, they obviously intend for their production profile to exceed that required for the minimum payment schedule. So that would imply sort of a profile of over 20,000 tons per year next year, increasing to 27,000 tons the following year, and then over 40,000 tons by 2023. So a significant large copper asset, and giving us long life exposure to a commodity that we're particularly bullish on. And then finally, Lake Rebecca. This was the acquisition announced last week. Very, very excited about this one. This is the kind of gold royalty that, had it been in Canada or Nevada, well, it wouldn't have been available for sale. It would have been gobbled up probably years ago when the project was much less advanced, and it probably would have been acquired for multiples of what we paid for it. This is a 1.5% NSR royalty over a plus million ounce deposit. The quick background on the asset is it announced its maiden resource just in February of this year. As I said, over 1 million ounces. So off of its maiden resource, it could be a standalone project in its own right. Now, the Apollo, the operator, is well-funded, has about 20 million Aussie in the bank from a fundraise following their resource announcement and then an asset sale as well. So they've got money that they're putting into the ground effectively. They're out there drilling furiously at the moment. And in fact, they've stated in their public reports that that based on just the drilling they've done to date, the resource is expected to grow. So from our perspective, it's as I said, could be a standalone project as it is today, but clearly the resource is going to increase from there. Apollo have stated publicly that they anticipate construction commencing in 18 to 24 months. I suppose they said that now a couple months ago. So you could see this sort of coming online in 2023, potentially sooner, but 2023 is sort of what we're envisaging. And then from there, it's going to be a substantial producer. It's in the most prolific gold region on Earth, and within a 100-kilometer radius, there's 18 gold mills operated by majors and mid-tiers, and a lot of opportunity there. We see this asset, as I said, potentially growing and being a significant paying gold royalty, probably well into the 2030s from our perspective. And so kind of a coup that we were able to acquire it. I think it fell under the radar. I think it fell under the radar of many of our peers that probably would have loved to have gotten their hands on an asset like this. And in terms of pipeline, I'm always somewhat restricted in what I can say in this regard, but hopefully at least this gives everybody a bit of a flavor of what we're seeing out there. We are seeing a good spread of opportunities in all three of the commodity sort of buckets that I've described: the base, precious, and bulk, battery, and industrial. We're also seeing a good spread with regards to geography. Important to note, probably Australia, we see a good amount of opportunities there. It's just a touch behind Canada in terms of the world's largest mining jurisdiction, but doesn't have yet a publicly listed royalty company. So there are a lot of royalties in existence that are ripe for consolidation. But even outside of that, we still see a good number of opportunities in North America, despite the level of competition there. Clearly, in non-precious metals, that competition isn't there. But a good amount of opportunity in North and South America, a good amount in Australia and Africa as well, obviously a resource-rich region. We're very pleased with what we're seeing, and quite frankly, we're sort of up to our eyeballs in opportunities. So we're aggressively going to continue to build the portfolio. And it's important to flag, I won't linger on this too long, but we do maintain a low G&A, and this is really one of the virtues of royalty companies more broadly. In fact, you'll see in other royalty company presentations, they love to extol the fact that their revenue per employee is in in many cases with some of the big boys in the multi-millions relative to the miners, which are much less than that. And it's down to the fact that we're acquiring financial instruments. We're not building and operating mines. So when you double the size of your portfolio, that doesn't necessitate the doubling of the size of our team. And in fact, you can look at the headcount of some of the majors, in the space. They're just very nimble, sort of small companies, because you're acquiring assets, you're putting them in your portfolio, and then you monitor them, you have them audited, but from there you're off to the next acquisition. I mentioned my and Ty's background. I won't go through each of the board members' CVs, but I think important to flag that we've got a good experienced board, the ideal mix of what you want to see with regards to mining finance experience, mining legal experience, and then, of course, technical experience. So, they're good at sort of setting the tone of the company and screening opportunities, and in fact, sourcing quite a few opportunities themselves. So I think we're very pleased with the broader team that we've assembled here. And finally, on our capital structure, I think important to flag, we were very, very conscious about keeping the structure clean. And what I mean by that is when you look at some peers in the space, whether they're royalty companies or miners, you often find the capital structures littered with warrants and options and convertible notes outstanding, and we don't have any of that. Effectively, we've got common shares outstanding. We've got a small management incentive options package, all priced at the IPO or higher, and all with sort of a long vesting criteria. We're equity incentivized, and we're completely aligned with shareholders in that regard. And probably also important to flag that we're supported by a number of good shareholders. Some of them are mining specific funds, some of them just sort of resource savvy or resource heavy, but all companies and firms that understand the space we're in, see the opportunity, and are very supportive of what we're doing. And in fact, we get a number of opportunities sent to us from some of our investors as well, which is something that I don't think many royalty companies can probably flag. And so in conclusion, I think we're in a good place. We've made a number of good acquisitions. As mentioned, we're cash flow positive. That probably sets us apart in its own right from relative to mining juniors. We're still well capitalized. We've deployed some of our capital, but as mentioned, we've still got cash in the bank. We've got the non-binding debt mandate with Tribeca for $10 million, and we've got the use of our listed equity. So a good amount of capacity to go out there and to continue to make acquisitions. We've got the right team in place. I think the market is responsive to what we're doing, and we see we're early days, but we're on the right path, and you can see sort of the value uplift, that's looming in front of us, and with each deal we're getting a little bit closer to that. So I've been prattling on now for about 40 minutes, but I'm happy now to pivot to the Q&A, Mark.
That's brilliant. Thank you very much indeed, Adam. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Adam takes a few moments to review the investor questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that feedback is incredibly important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations, and we'd very much encourage that if you could spare the time to do so. Adam, just ahead of looking at the questions that are coming in currently, we had a number of pre-submitted questions which I'd like to ask you, if that's okay.
Sure, of course.
That's brilliant, thank you. Congratulations on the Lake Rebecca Apollo transaction, which according to your 24th of September announcement is expected to start generating long-term revenue in 2023. Is it possible to give our expected rate of return on the capital we deployed on this transaction? And are there any production milestones we will be looking out for to confirm that the project is meeting our expectations or otherwise?
No, that's a really good question. And it's something that's hard to, I guess, difficult to convey in marketing material. And so this is sort of the perfect forum to address that. I guess there are a few ways that you could see the asset moving towards production. I suppose our base case is that, as mentioned, if they increase the resource, even if only a little bit, it is a standalone project in its own right, as it is today. So, the typical process is, they'll continue to drill, which they've been doing since February. If they get to a point where they say, this has got the critical mass to build the mine, and we're not finding enough to sort of continue to justify continued aggressive exploration, the next stage would then be to do a study on the project. And then from the study, off the basis of that, you can raise your capital for construction. And that probably does put it in sort of that 18 to 24 month timeline. And as I said, sort of on a standalone basis, that's a very good outcome for Trident. They'll build the operation. In terms of our expectations with regards to returns, we'd be looking in sort of the low 20s on a pre-tax basis, upper teens on post-tax. So that's, again, a very good return profile. You'll see majors in the space ranging between 5 to 7% pre-tax returns. So, I think this is consistent with our strategy. Now, where it gets a bit exciting is if they continue to drill and they make more discoveries, or as they infill drill and step out drill, they find more gold. Now, what that potentially does is delay production, because they're going to continue to drill. But that's absolutely not a bad thing. In fact, if they're finding more and they want to continue drilling to drill it out, that's a very, very good thing, because what that means is this deposit transforms into from 1 million ounces to 1.5 to 2 million, or more from there potentially. And so that delays that process of then going to a study and then going into construction. But clearly, if they double the size of the resource, that doubles the size of our revenue profile. And makes that return profile sort of commensurately better. So that would be an exceptional outcome as well, and in many cases would obviously be preferred. And then the third one, which is more of a blue sky scenario, is, as I mentioned, this operation is surrounded by mid-tiers and majors. Now, the mid-tiers and majors, more broadly in the gold space, they're always looking for more ounces, right? So you can go out there and try to make a new discovery and find your own million-ounce deposit and drill it out from there, or you can find an explorer who's already done that for you and acquire them. No, we can't bank on that. That's certainly not our base case. But effectively, if that were to happen, then and they were acquired, then what you would see is rather than needing to build their own plant, it would be treated through an existing plant of a nearby major or mid-tier, which doesn't then, you still have the upside of the resource expanding, but it cuts out that whole fundraising and construction timeline. So brings cash flows forward with regards to the royalty. So those are sort of the three scenarios of how we'd see the project coming to fruition. As I said, all three scenarios are a very good outcome for Trident, and all three of the three, we're obviously basing our assessment on our base case, I guess, on the sort of lowest upside type scenario. But yeah, it all circles back to finding defensive assets with compelling economics and the critical mass to become a project. And that's where you want to invest in development stage assets. So with regards to the original question of what should we be looking for, it would be tracking Apollo's announcements as they're adding ounces to the resource profile. For example, the Clio deposit, which is to the west of sort of the main ore body that they're found. they've had really, really good intercepts there, but it doesn't yet have a resource over it. So, we'd be, and they're doing the drilling on the 4-kilometer strike length between the Duke and Duchess deposit and the Rebecca sort of central deposit. And again, have had good intercepts, but there's not a resource over it yet. So it'd be monitoring that, and that will indicate to us whether this will move straight into the study phase, and then from there chug towards construction, or whether they continue to drill, whether the upside is there to make it worthwhile to continue to drill and try to make this thing much larger.
Thank you. There was actually a supplementary question from the same investor who asks, this transaction uses about 1/3 of our cash. How much firepower do we have left for transactions this year? And what commitments have we got to leave a more credit based on our steadily growing revenues?
No, again, a good question. Hopefully I addressed it a little bit over the course of the presentation, because we aren't constrained to obviously just the cash in the bank. There is the ability to tap into that $10 million debt mandate. And indeed, we're not restrained to 10 million on the debt front either. If we, making up numbers, but if we see an acquisition for 20 million, we can get a larger debt facility to support that acquisition in addition to the cash we have in hand, and then, as I said, the ability to use listed equity as well. So we're not feeling constrained at all in that regard. I think we're conscious, and I think what the question's probably getting at is this a business model that sees you continually going to the trough to do equity raises? And the short answer is no. It doesn't necessitate that. If we were to go back out and do another equity raise, it would likely be against a specific asset rather than doing sort of a blind pool of capital. So it would be going out with a specific accretive asset, most likely one that we've got debt lined up against, and that would be a good outcome for all shareholders. No, not feeling constrained yet.
Perfect. There is a question of share price, so I'll throw this out at you as well, if I may. If Trident starts being valued on the same basis as larger royalty companies, how high could we expect the share price to go?
Yeah, I mean, that's a good question, and it's that's what we're all driving towards. I hate to sort of say how high it could be, because I don't think there is a cap. I mean, I think you've seen from some of the performance, even the majors who had big market caps were able to grow significantly. So they're adding tens of millions of value. We're still a relatively small company, so the ability to double, triple, quadruple our share price, there's no upside cap in that regard. As we acquire additional assets, and I've given an indication of what our internal assessment is of some of the return profiles. Those are very attractive returns and accretive to investors. So if you can continue to do deals in that vein, I don't think there is an upside cap. Now, clearly, we've been pretty open with the fact that, and I talked to it a bit earlier, that as you build the size and scale and diversification of your portfolio, you garner more of that sort of premium valuation uplift. And I think that is just an iterative process. As we grow, we're going to realize that over time. So on top of you get this dual fired benefit. On top of doing accretive transactions, you're also getting a company level wide valuation uplift that is then applied to all of your assets, not just that one that sort of helped further it along. So that's really why the royalty model sort of has this accelerated return profile, and quite frankly, that's what excited the board and management to get involved in this. It's been a lot of work, but the prize is there, and that's what we're working towards.
Thank you very much. There's just two more pre-submitted questions, and I think you've definitely touched on this, but perhaps you could just, for clarity, just perhaps put a little more detail. Are there any territories you would not look to make transactions in, and typically, how would you protect your position / investment in the transactions you do complete?
I think so. There are jurisdictions we wouldn't be racing off towards. We're unlikely to go and acquire royalties in Russia, for example. But that said, we are open to pretty much every geography. The important thing to flag is it has to have the proper legal framework to support royalties, because there are some jurisdictions that don't have that, in which case you can still put a royalty in place, but it's a contractual royalty between you and the operator of the asset. So if they go into bankruptcy, for example, then that contract is effectively torn up. We prefer jurisdictions that have common law that you can peg the royalty to the ground. It survives bankruptcy. So it's really those elements that are driving our view on geography, as well as, of course, we've got to price in political risk or jurisdictional risk more broadly.
Thank you. And the final question around competition in the market. What is the competition like when competing for royalties at the smaller end of the market, and really what differentiates you?
Yeah, hopefully I've largely addressed this. I mean, I think in the smaller end of the market, the first thing to flag is there's increasing competition, but it's still a space. we've been surprised. In fact, I think when you look at the newly listed royalty companies this year, everybody uniformly seems to be following that path of precious focus, TSX listed. So although I suppose simple way of saying it is, if there's a small asset royalty in North America in precious metals, it's going to be fierce competition. And we've looked at quite a few. But we're still not seeing the competition outside of precious metals and outside of the Americas more broadly. So as of yet, our competition is largely equity. If a miner in particular wants to raise some capital and they're open to a royalty, there aren't too many players that would be looking outside of the Americas and looking non-precious. So we're competing with equity providers in that regard.
Okay, perfect. Thank you. Well, Adam, that definitely deals with the pre-submitted questions we received. If I could just ask you to have a look at the Q&A section on your screen. Obviously, you'll see that there's been a number of questions come in, and I wondered if I could just ask you to read out the question and give your response to those where it's appropriate to do so at this time.
Yep, sure. I'll start at the top here. So the first one is, as the company grows, would you consider a Canadian, US, or Australian listing? I think the short answer is we're always conscious of the potential that could hold. I mean, the key thing is it has to be done at the right time, right? You only get one shot at something like that. And if it's mismanaged, then it's a waste of time and money and has ongoing, obviously, requirements with regards to reporting and everything else. So you don't want to get it wrong at the end of the day. So, you can do it as a junior. We're pleased with our progress so far. We've got a nice portfolio. We've got revenue. We've got a 40 million plus market cap. But do you want to do that now, or do you want to wait until you're plus 100 million market cap and you've got 12 million in annual revenue and you're paying a dividend, and you can really make a splash when you do that dual listing? So we're conscious of all that sort of stuff. So I guess to answer the question in short, we would certainly consider it, and we're just conscious that it has to be at the right time. Let's see. Next question is it inevitable that the North American companies will catch on and enter your space with regards to finding deals that have previously been under the radar? No, I think there's value there. We're finding attractive deals. So I think there will be competition. I don't know how quickly it will come to fruition, but I think we're very conscious that there's a window of opportunity here. And whether it's us, I've said this before, whether it's us or whether it's somebody else, there will be a plus $1 billion market cap diversified mining royalty company out there at some point in time. So I think we're conscious of it. And you've seen the pace at which we've been moving, not yet listed for 4 months, but have announced 5 transactions and 8 royalties, and 2 of those paying. So we're jumping straight into it with the mindset that this may not be here forever. So we need to capitalize on it today. Let's see, next question is it too early to be thinking about paying dividends when there are plenty of attractive opportunities out there? Well, I think the short answer is we're conscious that, particularly as a UK listed company, relative to some of our TSX listed peers, our peers, given that TSX is the biggest mining exchange in the world, they can largely get away with being valued on development exposure, development upside, or at least much more easily than we can. We're going to be driven by our cash flow multiples, and paying a dividend is just going to open us up to other pools of capital that would otherwise be closed to us. So the short answer is yes, it's too early at our cash flow profile as it is today. We'll get better returns for shareholders by turning around and deploying that capital on our next acquisitions. But that said, we need to be forming a view on when is the right time, and most importantly, informing the market when we see that, so that there is that goalpost that we're working towards, and the market can see when that's going to come to fruition. And I think probably important to flag that and I said it in the midst of the presentation, but this is a high priority for both management and the board to get to the point where we can pay, importantly, a sustainable dividend, and ideally a dividend that's from diversified sources of revenue, such that it is giving shareholders that broad diversified exposure to the mining sector. That's the crux of the strategy. So we've got to get to the portfolio to the stage where it can support a sustainable dividend from a diversified asset base. And as I said, we're well on the way there. I think over the course of the next 12 months, our revenue from the existing royalties will become known, and we'll obviously be adding new royalties. And important to flag, we're prioritizing production or near production assets. So we'd be hopeful that in the nearest term that we'll see that revenue profile flesh out. Let's Let's see. The next one is how can you ensure that the operator will account accurately and honestly for the excavated material, especially if the operations cover additional non-royalty areas? Yeah, this is an area that some of these specialized accounting firms, Grant Thornton or BDO, that they have teams that focus on this specifically. So this is an area that's reasonably well trodden. You do have audit rights embedded in the royalty deeds in almost all cases, and so you get reporting. You get to analyze that and then put it to the mining operator, and there have been adjustments made on many royalties. You can look through our peers that as they audit a royalty, they'll say you accounted for transportation incorrectly, and then a true up will be made. So that's never really presented a major issue for most royalty companies. So the next one is what will be your approach to depreciation of assets? Will you revalue the asset in some way on a periodic basis, and if so, how? Clearly, it's only an accounting exercise, but it's a significant factor in terms of P&L and balance sheet. That's a very good question. You would have seen our interims were announced today, and financial statements for royalty companies are sort of notoriously messy to untangle for this very reason. Most people focus on the cash flow statement because that does give you sort of the true, what are you earning and what's the cash being generated. Because the fact is, you want to depreciate as much as possible of the royalty. You want to front load that as much as possible to minimize your tax burden. So the short answer is that each asset's a little bit different. So for example, Mimbula, having that sort of minimum payment schedule makes the asset sort of slightly debt-like in that regard. So it would be treated differently than, say, Kulianoving. So it depends on the asset and how the royalty deed is drafted. But yeah, it's very true that does have a significant impact on P&L, and the ability to amortize the royalty, the purchase price against the revenues from the royalty is clearly almost, or in some cases, probably more important than some of the technical aspects of the underlying operation, because what you don't want to do is buy a $10 million royalty and then start paying full tax on the revenue from day one. You want to be able to use that $10 million purchase price to offset any tax on the revenue as long as possible, and then obviously front loading that as much as you can to minimize your tax burden. So it's that could take sort of an hour in its own right to delve into, but hopefully that gives you a bit of a flavor that is something we're very conscious of and spend a lot of time and effort on. Next question is, can you comment on why you are listed in London rather than a more commodity-aware jurisdiction like Australia? I think this goes back to, I suppose there's two factors. One is Trident was already listed in the UK, so there was sort of a practical element to it. Another thing to flag is, London started the year with one listed mining royalty company. It now has two. Wheaton Precious Metals has announced that they'll be pursuing a dual listing in London. So clearly they see value in undertaking that initiative. And then the Ghanaian government is IPOing, targeting a $500 million IPO of their royalties over projects in Ghana. They had the world to pick from, and they selected the London Exchange. So London started the year with one royalty company, is ending the year with four. I don't think it does come with its nuances. As mentioned, I think London's going to be more focused on our cash flow multiples versus mining specific development upside, for example. But I don't think that it's a constraining factor. At the end of the day, London's one of the biggest capital markets in the world, and I think it's been proven both on the resources side and then non-resource royalty companies that they can get good traction in the market, and that the story resonates. And I think that's, it's now easier to answer that question. The fact that we're a few months out of the gate and we've seen our share price rise off good liquidity, rise 50%. And then with the announcement of Wheaton in the Ghanaian vehicle as well, I think clearly other parties don't view London as a constraining factor, and we certainly don't either. The next one is, would you comment on whether you would consider uranium or coal royalties? So we're certainly open to uranium. We're open to coking coal, so we do exclude thermal coal, which is energy coal used to feed power plants. We exclude it for ESG reasons and for practical reasons. Increasingly ESG factors are taken into consideration by investors, and it could close us off to pools of capital that would otherwise be available. So it's both a preference of the board and management as well as some practical constraints. So we're open to uranium. We're open to energy, I guess, in that regard, with regards to uranium, and we're open to coking coal for steel making, but not for thermal coal. The next one is, what are the terms on the Tribeca debt line? So the terms are sort of it's going to be drawn when we need it for a specific asset acquisition. So that asset acquisition is effectively going to inform what the terms will look like. Now you can go out there and look at what Tribeca has done in terms of other debt facilities, and suspect it's going to be along that range. It should be on the lower end of the range because, as described, as a diversified royalty model with cash flow, we're a different risk profile than a miner who's in development. So we should be on the lower range of that profile, but it is going to largely be driven by what the debt's being drawn for, and what our portfolio looks at that point in time as well. The next one, and we've got 3 left here, so I'll try to get through them quickly. Also, could you comment on the hurdle rate you're looking for regarding the building blocks for that? Do you use a flat forward price assumption for the relevant commodity or the futures curve? Yeah, so with regards to return hurdles, obviously it depends on commodity, jurisdiction, the operator, whether it's a major versus a junior. So a number of factors play in there. So there's not sort of one hard and fast return profile that we're looking for. I did mention them in the presentation, sort of what our targets were for the sort of 3 assets that I flag as our key assets. And they range from sort of the upper teens to upper 20s in a post-tax basis. Now we would delve lower than that for the right asset, and we'd go higher than that for development stage assets that have higher risk profiles. But yeah, so as to not avoid the question completely, that's roughly the range. Anywhere I'd say from mid-teens to mid-20s is probably a suitable range, and I think for a vehicle such as this, and with interest rates at 0.25%, I think that's a really attractive profile. Oh, sorry, and the latter part of that question is what pricing assumptions we use for the underlying commodities. Again, it varies. And we look at it every which way. We use spot. We use flat pricing. We do sensitivity analysis in that regard. We'll use the futures curve. We'll use the consensus economics curve. In certain commodities, we'll do Marco Polo sensitivity analysis to see what the return profile looks like on a stochastic basis. So a number of ways you can look at it. There's not sort of one way that will sort of point to what true value is going to be. It's ultimately a range. Next one is, do you have a target year for commencement to pay dividends? No, we don't have a target year because it's going to be driven by the portfolio. For example, we're looking at royalties that are largely scrip driven. So it all lends itself to the fact that our cash flow profile could change significantly and may not even impact our cash balance in a meaningful way in some cases. So it's hard to peg a calendar year on it. I think probably a better way to look at it is when we get to a sustainable revenue level. And again, I hate to dodge questions, so I'll sort of put it out there and take it with the caveat that this can sort of change, of course, and is subject to other views as well. But I think when we cross sort of the 10 million pre-tax revenue line, to 10 million US a year on a sustainable basis, that's where you could say, at this level, we can support debt facility from incoming revenue. That still gives us a good amount of capacity to make acquisitions, and we can also support a dividend on a sustainable basis. So that's sort of the soft target in my mind. And as I said, I think you can look at the payments thus far on Kulinabi on an annualized basis. What we've achieved through 2020, just through July, would be over 2 million US if that's annualized. Mimbula, you can look to a minimum payment schedule next year, 1.5 US, the following year 2 million US, and then in the first half of 2023, 1.5 US. So we haven't put market guidance out there with regards to revenue, but you can look at our historic. You can look at the minimum profile, and you can make your own assessment from there. But short answer is we're well progressed in that regard with regards to getting to that soft target. And let's see, the final question I see here is, can you explain the NS in NSR? So it's NSR is a net smelter return. So effectively, a gross revenue royalty is just without any deductions. The company makes $1, and you get your percentage of that single dollar. A net smelter piece of it is just their revenue back from the smelter. So, and it's usually very close to gross revenue. It depends on the commodity, but in the case of gold, you may send it to the smelter, and often the smelter charges a fee based on payability. So they'll return the gold to you, they'll sell on the gold and pay you 99.6% of the spot gold price at that point in time. So then we're getting our percentage of that net smelter revenue that's coming back to the company, rather than on sort of a gross spot basis. So it's just effectively a minor deduction. And royalties can be sliced and diced. You can deduct transportation. You can deduct all sorts of things. An NSR is effectively, for a gold producer specifically, that's the revenue that the company's receiving. So you tend to see them classified as NSR royalties because that's what the mining operator wants to be paying on.
That's brilliant, Adam. I think you, as you said, have gone through every single question that's come through. You'll probably need a break after this, so thank you once again. Perhaps, Adam, I could just ask you to perhaps just wrap up. And I know that investor feedback is incredibly important, so I will then direct investors to provide that for you.
Yeah, no, I think we've touched on pretty much all the key points, and hopefully this, from my perspective, is a really good event to be able to spend a good amount of time, discussing the strategy, discussing the assets, and then answering the questions that came in. That said, I think we're always available to answer follow-up questions in my emails and our corporate presentation. I'm happy to answer questions directly or line up a subsequent call. It's important for us to get the message out there, and that's a key part of my job. So I appreciate everybody attending the event, and happy to follow up if there are any lingering questions out there.
That's brilliant. Thank you very much indeed, Adam. Could I ask, please, investors not to close the session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you access this meeting from our website, the feedback page will appear in a couple of moments. And if you access this via the link sent to you by email, you'll be simply asked to log back in to provide your feedback. On behalf of Trident Royalties, we'd like to thank you for attending today's presentation. That now concludes today's session. Good morning to you over in the US, and good evening to everyone